Question 1. The efficiency study reveals that many small business owners prioritize cost reduction when purchasing insurance. A client, operating a small artisanal bakery, expresses a strong desire for the most affordable insurance policy available, stating that they don't want to pay for coverage they might never use. As an insurance professional, what is the most appropriate regulatory compliant approach to addressing this client's request? Option A. Conduct a detailed risk assessment specific to the bakery's operations. Identify potential liabilities and exposures, and then explain how different coverage options address these specific risks, demonstrating the value and necessity of appropriate protection even if not all coverages are immediately utilized. Option B. Recommend a standard, low-cost general liability policy that covers basic third-party claims, assuming this will be sufficient for most small businesses. Option C. Present a comprehensive policy with numerous optional coverages, explaining that while it may be more expensive, it offers the broadest protection, and let the client decide if they want to remove any options. Option D. Provide the client with a list of the cheapest available policies from various insurers and allow them to select the one that best fits their budget without further discussion of specific risks. Correct answer is A. Conduct a detailed risk assessment specific to the bakery's operations, identify potential liabilities and exposures, and then explain how different coverage options address these specific risks, demonstrating the value and necessity of appropriate protection even if not all coverages are immediately utilized. Explanation. This scenario is professionally challenging because it requires the insurance professional to balance the client's immediate perceived needs with the regulatory obligation to provide appropriate coverage. The client, a small business owner, is focused on cost savings, which is understandable, but may lead them to overlook essential protections. The professional must navigate this by educating the client on the risks and the regulatory requirements, without being overly prescriptive or dismissive of their budget concerns. The correct approach involves a thorough needs analysis that considers the specific risks faced by the small business, aligning with the regulatory framework for delivering insurance services. This includes identifying potential liabilities, property damage risks, and business interruption exposures relevant to the client's industry. The professional must then explain how different policy types and coverage levels address these risks, referencing relevant regulatory guidelines that mandate adequate disclosure and suitability of advice. This ensures compliance with the duty of care owed to the client and adherence to principles of responsible insurance provision. An incorrect approach that prioritizes the client's stated preference for the cheapest option without a comprehensive risk assessment fails to meet regulatory standards. This could lead to underinsurance, leaving the business vulnerable to significant financial losses that a properly structured policy would cover. Such an approach breaches the duty to advise appropriately and could result in regulatory sanctions for failing to act in the client's best interest. Another incorrect approach, offering a generic one-size-fits-all small business package without tailoring it to the specific operations of the client's business, also falls short. While seemingly efficient, it ignores the unique risk profile of each business and may not provide the necessary coverage for specific industry exposures. This demonstrates a lack of due diligence and a failure to comply with the principle of providing advice that is suitable for the individual client's circumstances, as often stipulated in regulatory codes of conduct. A further incorrect approach, pushing a policy that includes extensive optional coverages the client does not understand or need, while potentially increasing the premium, is also problematic. This can be seen as mis-selling or failing to provide clear and understandable information, which is a cornerstone of regulatory compliance in insurance sales. The focus should be on essential protection that addresses identified risks, not on maximizing sales through unnecessary add-ons. The professional decision-making process should involve a structured needs assessment, clear communication of risks and coverage options, and a documented rationale for the recommended policy. This process ensures that advice is both compliant with regulation and genuinely beneficial to the client's business. Question 2. Operational review demonstrates that a significant emerging cyber threat poses a substantial risk of data breaches and operational disruption for a large portfolio of commercial clients. The potential financial impact of a single major incident could be severe, potentially exceeding the insurer's current capital reserves if left unmanaged. The insurer is considering how to best manage this risk. Option A. Risk retention. Option B. risk avoidance. Option C, risk reduction. Option D, risk transfer. The correct answer is D, risk transfer. Explanation. This scenario presents a professional challenge because it requires the insurance service provider to balance the immediate financial implications of a risk with its long-term impact on client relationships and regulatory compliance. A hasty decision based solely on cost reduction could lead to a breach of duty of care or misrepresentation, jeopardizing the firm's reputation and potentially incurring greater future costs through claims or regulatory penalties. Careful judgment is required to select a risk management technique that is both effective and ethically sound, aligning with the principles of good governance and client best interests. The correct approach involves risk transfer. This technique is appropriate when the potential financial impact of a risk is significant and unpredictable, and when the cost of transferring that risk is less than the potential cost of retaining it. In the context of delivering insurance services, this often means ensuring that the insurance policies themselves are structured to cover specific, high-impact events. This aligns with regulatory expectations that insurers provide adequate coverage and manage their own underwriting risks effectively. By transferring the risk to a reinsurer or through appropriate policy design, the insurer can protect its financial stability and its ability to meet its obligations to policyholders, thereby upholding its regulatory duty to operate soundly. An approach focused solely on risk avoidance, by refusing to offer coverage for certain emerging risks, could be seen as failing to meet market needs or potentially acting in a way that is not in the best interests of potential clients who require such coverage. While avoidance is a valid technique, its application must be carefully considered to avoid creating market gaps or appearing to be unsupportive of legitimate business activities. An approach focused on risk reduction, by implementing stringent underwriting criteria that significantly limit coverage or increase premiums to an unaffordable level, might be perceived as an indirect form of avoidance or an attempt to retain risk without adequately compensating for it. While reducing the likelihood or impact of claims is important, it should not come at the expense of providing a viable and fair insurance product. An approach focused solely on risk retention, by deciding to self-insure against all potential losses, would be a significant regulatory failure. Insurers are regulated entities with solvency requirements designed to protect policyholders. Unmanaged and unlimited risk retention by an insurer would expose policyholders to unacceptable levels of risk and would likely contravene prudential regulatory requirements designed to ensure the financial soundness of insurance providers. The professional decision-making process for similar situations should involve a thorough assessment of the nature and potential impact of the risk, considering both financial and reputational consequences. This assessment should be informed by regulatory requirements, market conditions, and the insurer's own risk appetite and capacity. The chosen risk management technique must be demonstrably effective, ethically sound, and compliant with all applicable laws and guidelines, ensuring that client interests and regulatory obligations are paramount. Question 3. Operational review demonstrates that a policyholder has submitted a claim for a medical procedure that appears to be an exclusion under their individual health insurance policy. The policyholder, an elderly individual with limited health literacy, is distressed and believes they are fully covered. The customer service representative has identified the exclusion, but is concerned about the policyholder's emotional state and potential misunderstanding of the policy. What is the most appropriate course of action for the customer service representative? Option A. Explain the specific exclusion in clear, simple terms, confirm the procedure is not covered under that exclusion, and then explore any potential alternative coverage options or policy benefits that might still apply or be relevant to the policyholder's situation. Option B. Advise the policyholder that while the procedure is excluded, the insurer will make a one-time exception due to their distress and the perceived misunderstanding. Option C. Inform the policyholder that the claim is being denied due to the exclusion and suggest they seek legal advice on how to challenge the insurer's decision. Option D. Immediately deny the claim, citing the exclusion, and advise the policyholder to review their policy documents for clarification. The correct answer is D. Immediately deny the claim, citing the exclusion, and advise the policyholder to review their policy documents for clarification. Explanation. This scenario presents a professional challenge because it requires balancing the insurer's need to manage risk and ensure the sustainability of its products with the ethical obligation to treat customers fairly and provide accurate information. The challenge lies in interpreting and applying the policy terms and conditions in a way that is both legally compliant and ethically sound, especially when a customer's understanding of their coverage may be incomplete. Careful judgment is required to avoid misrepresentation or misleading the customer, which could lead to regulatory action and reputational damage. The correct approach involves clearly and accurately communicating the policy's limitations and exclusions to the customer, while also exploring available options that might still meet their needs within the policy's framework or through alternative products. This upholds the principle of transparency and fair dealing, ensuring the customer is fully informed about their coverage. Regulatory frameworks, such as those governing consumer protection in insurance, mandate that insurers provide clear, accurate, and not misleading information to policyholders. Ethically, this aligns with the duty of care owed to customers. An incorrect approach would be to simply deny the claim without thoroughly explaining the reasons based on the policy wording, or to offer a vague explanation that leaves the customer confused. This could be seen as a failure to act in good faith and could violate regulations requiring clear communication of policy terms and claim decisions. Another incorrect approach would be to offer a workaround that circumvents the policy's exclusions without proper disclosure or consideration of the customer's long-term needs, potentially leading to future dissatisfaction or regulatory scrutiny for mis-selling. Professionals should approach such situations by first thoroughly understanding the policy terms and the customer's situation. They should then communicate the policy's provisions, including any relevant exclusions or limitations, in a clear and understandable manner. If a claim is denied, the rationale must be explicitly stated, referencing the specific policy clauses. The professional should then explore all legitimate options for the customer, which might include explaining how the policy does cover certain aspects, suggesting alternative treatments that fall within coverage, or discussing other products that might be more suitable. This systematic process ensures compliance with regulatory requirements for fair treatment and ethical conduct. Question 4. The evaluation methodology shows that an insurance representative is discussing a life insurance policy with a 16-year-old individual who is eager to purchase coverage for themselves and has the funds to pay the initial premium. The representative needs to determine the most appropriate course of action to ensure the validity of any potential insurance contract, adhering strictly to the principles of contract law as they apply to insurance services. Which of the following actions best upholds the requirements for a valid insurance contract in this scenario? Option A. Advise the 16-year-old that they can sign the policy documents, but the policy will only become effective once they turn 18, thereby circumventing the issue of competency. Option B. Inform the 16-year-old that insurance contracts are only for adults and they must wait until they are 18 years old to apply for any coverage. Option C. Explain to the 16-year-old that while their interest is noted, the policy cannot be issued directly to them due to their age, and suggest that a parent or legal guardian apply for the policy on their behalf. Option D. Proceed with issuing the policy to the 16-year-old, as their expressed desire to purchase and ability to pay the premium demonstrate a valid offer and acceptance, fulfilling the contract's requirements. The correct answer is C. Explain to the 16-year-old that while their interest is noted, the policy cannot be issued directly to them due to their age, and suggest that a parent or legal guardian apply for the policy on their behalf. Explanation. This scenario is professionally challenging because it requires the insurance representative to identify the fundamental legal requirements for a valid insurance contract, specifically focusing on the element of competent parties. Misinterpreting or overlooking this element can lead to the formation of an unenforceable contract, exposing both the insurer and the client to significant risks and potential legal disputes. The representative must exercise careful judgment to ensure all contractual prerequisites are met. The correct approach involves recognizing that a minor, due to their legal status, generally lacks the full contractual capacity to enter into a binding insurance agreement. While an insurer might issue a policy, it would likely be voidable at the minor's discretion. Therefore, the most appropriate action is to explain that the policy cannot be issued directly to the minor and suggest that a parent or legal guardian apply for the policy on the minor's behalf, acting as the policyholder. This aligns with the legal principle that competent parties are essential for a valid contract. Minors are typically considered legally incompetent to contract independently. This approach upholds regulatory requirements by ensuring the contract is legally sound and enforceable from its inception. An incorrect approach would be to proceed with issuing the policy directly to the minor, assuming their stated desire to purchase the insurance constitutes valid acceptance, and that the premium payment is sufficient consideration. This fails to address the critical element of competent parties. The regulatory framework for delivering insurance services mandates that contracts be legally binding. Issuing a policy to a minor who can later disaffirm it creates a contract that is not truly valid and enforceable, leading to potential regulatory breaches related to misrepresentation or providing advice that results in an invalid agreement. Another incorrect approach would be to dismiss the minor's interest entirely without offering an alternative solution. While legally sound in that contract with a minor is problematic, it fails to demonstrate a commitment to delivering insurance services in a helpful and informative manner. The professional duty extends beyond simply identifying legal barriers. It includes guiding clients towards legally viable solutions. This approach, while avoiding an invalid contract, misses an opportunity to serve the client effectively and could be seen as a failure in customer service and professional conduct. The professional reasoning process for similar situations should involve a systematic review of the core elements of a valid contract: offer, acceptance, consideration, competent parties, and legal purpose. When faced with a situation involving a potential contractual party whose capacity is in question, such as a minor, the professional must prioritize the competent parties element. The decision-making framework should involve 1. Identifying the potential issue, e.g., age of the applicant. 2. Recalling the relevant legal principle, e.g., contractual capacity of minors. 3. Determining the legal consequence, e.g., contract is voidable. 4. Proposing a legally compliant and client-focused solution, e.g., involving a guardian. This structured approach ensures that legal requirements are met while also providing effective service. Question 5. The performance metrics show a consistent trend of policy surrenders within the first 2 years of issuance for a particular product line. A client contacts you expressing a desire to surrender their policy, stating they need immediate cash. You know this policy has significant surrender charges in the early years, and that policy loan might be a more financially prudent option for accessing funds without incurring such penalties. Under state insurance laws, what is the most appropriate course of action for the agent? Option A. Suggest the client take out a policy loan and then immediately initiate the process of replacing the existing policy with a new one that has lower surrender charges. Option B. Fully explain the surrender charges and penalties associated with early withdrawal, clearly outline the net proceeds the client would receive, and present alternative options like a policy loan, detailing its terms and implications to help the client make an informed decision. Option C. Advise the client to surrender the policy and use the proceeds to invest in a different financial product that you believe offers better returns. Option D. Immediately process the surrender request as the client has explicitly asked for it to ensure client satisfaction and a quick resolution. The correct answer is B. Fully explain the surrender charges and penalties associated with early withdrawal, clearly outline the net proceeds the client would receive, and present alternative options like a policy loan, detailing its terms and implications to help the client make an informed decision. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the insurance agent to balance the immediate financial needs of a client with the long-term implications of policy suitability and regulatory compliance. The client's expressed desire for a quick payout, coupled with the agent's knowledge of a potentially more beneficial long-term solution, creates a conflict. The agent must navigate this by adhering strictly to state insurance laws, which prioritize consumer protection and fair dealing, while also maintaining a professional relationship with the client. The pressure to close a sale or satisfy a client's immediate request can sometimes overshadow the agent's fiduciary duty and regulatory obligations. Correct approach analysis. The correct approach involves thoroughly explaining the policy terms and conditions, including any surrender charges or penalties associated with early withdrawal, and then presenting alternative options that might better serve the client's long-term financial goals, such as a policy loan or a partial withdrawal if permitted and beneficial. This approach is right because it aligns with state insurance laws that mandate agents to act in the best interest of the client and to provide accurate, complete, and understandable information. Specifically, these laws require agents to assess the client's needs and recommend suitable products, which includes advising on the consequences of policy actions like surrendering a policy. Ethical considerations also demand transparency and a commitment to client welfare over immediate commission. Incorrect approach is analysis. Proceeding with the surrender without fully explaining the financial implications and alternatives fails to uphold the agent's duty of care and may violate state laws requiring suitability and full disclosure. This approach prioritizes the transaction over the client's best interests and could lead to significant financial detriment for the client, potentially resulting in regulatory action against the agent. Suggesting the client simply take the money without detailing the surrender charges or exploring other options is also an inadequate response. This bypasses the agent's responsibility to provide comprehensive advice and could be interpreted as facilitating a decision that is not in the client's best interest, thereby contravening state regulations on fair practices and consumer protection. Recommending a new, potentially more expensive policy to replace the existing one without a clear, documented analysis of why the new policy is superior and how it addresses the client's stated needs and financial situation is a red flag for replacement business. State insurance laws often have specific regulations around policy replacements to prevent misrepresentation and ensure clients are not disadvantaged by switching policies. This approach could be seen as an attempt to generate a new commission at the client's expense, violating principles of suitability and fair dealing. Professional reasoning. Professionals should approach such situations by first actively listening to and understanding the client's stated needs and motivations. Then they must access their knowledge of the product and relevant state insurance laws. The decision-making process should involve 1. Identifying the client's immediate request and underlying needs. 2. Evaluating the existing policy's features and the consequences of the requested action surrender. 3. Researching and presenting all viable alternatives, including their pros and cons, in a clear and understandable manner. 4. Documenting the entire interaction, including the advice given and the client's final decision. This systematic approach ensures compliance with regulations, upholds ethical standards, and protects both the client and the agent. Question 6. Market research demonstrates that customers and the wider community are increasingly valuing insurers that demonstrate a strong commitment to corporate social responsibility. An insurance company is considering how to best respond to this trend. Which of the following approaches best aligns with delivering insurance services responsibly and ethically, considering the diverse stakeholder landscape? Option A. Prioritize CSR activities that demonstrably enhance shareholder value through cost savings or revenue generation, even if these activities have limited broader social or environmental benefits. Option B. Focus CSR efforts solely on initiatives that offer the most direct and measurable marketing benefits, such as sponsoring high-profile events that align with the company's brand image. Option C. Allocate a small budget for ad hoc charitable donations to various causes, primarily driven by the personal preferences of senior management, without formal stakeholder consultation or integration into business strategy. Option D. Develop a comprehensive CSR strategy through consultation with employees, customers, community representatives, and environmental groups, integrating these initiatives into the company's core business operations and reporting transparently on progress and impact. The correct answer is D. Develop a comprehensive CSR strategy through consultation with employees, customers, community representatives, and environmental groups, integrating these initiatives into the company's core business operations and reporting transparently on progress and impact. Explanation. This scenario is professionally challenging because it requires balancing the company's financial objectives with its ethical and social responsibilities towards various stakeholders. The AIS 25 exam focuses on delivering insurance services, which inherently involves trust and a duty of care. Therefore, decisions regarding corporate social responsibility, CSR, must align with regulatory expectations and ethical principles governing the insurance industry. Careful judgment is required to ensure that CSR initiatives are genuine, impactful, and do not serve as mere superficial marketing tools, which could lead to reputational damage and regulatory scrutiny. The correct approach involves actively engaging with a diverse range of stakeholders to understand their expectations and concerns regarding the insurer's social and environmental impact. This proactive engagement allows the insurer to develop CSR strategies that are relevant, meaningful, and aligned with the company's core values and business operations. Regulatory frameworks, such as those governing consumer protection and corporate governance, implicitly encourage transparency and accountability in business practices, including CSR. Ethically, this approach demonstrates a commitment to good corporate citizenship, fostering long-term trust and sustainability, which are crucial in the insurance sector. An incorrect approach that prioritizes only shareholder returns would fail to acknowledge the broader impact of the insurer's operations on the community, employees, and customers. This narrow focus can lead to decisions that, while maximizing profit in the short term, may alienate stakeholders, damage the company's reputation, and potentially attract negative regulatory attention for neglecting social responsibilities. Ethically, it represents a failure to uphold a duty of care beyond immediate financial beneficiaries. Another incorrect approach that focuses solely on public relations and marketing benefits would treat CSR as a superficial branding exercise. This approach lacks genuine commitment and can be perceived as disingenuous by stakeholders. If the CSR activities are not integrated into the company's operations or do not address genuine social or environmental issues, it can lead to accusations of greenwashing or social washing, resulting in a loss of trust and potential regulatory sanctions for misleading practices. Ethically, this approach is deceptive and undermines the integrity of the company. A third incorrect approach that delegates CSR decisions entirely to a single department without broader consultation risks creating initiatives that are disconnected from the company's overall strategy and stakeholder needs. This siloed approach can lead to inefficient resource allocation and CSR efforts that do not resonate with the intended beneficiaries or align with regulatory expectations for responsible business conduct. Ethically, it suggests a lack of genuine commitment from senior leadership and a failure to embed CSR principles across the organization. The professional decision-making process for similar situations should involve a systematic stakeholder analysis, identifying all relevant parties and their interests. This should be followed by a thorough assessment of potential social and environmental impacts of the insurer's operations. Based on this understanding, the insurer should develop a CSR strategy that is integrated with its business objectives, transparent in its execution, and accountable in its reporting. Regular review and adaptation of CSR initiatives based on stakeholder feedback and evolving societal expectations are also critical for maintaining ethical and regulatory compliance. Question 7. System analysis indicates that a new client, operating a small manufacturing business, has requested full protection for their operations and is concerned about potential lawsuits arising from product defects and workplace accidents. They have asked for a commercial general liability (CGL) policy that covers everything. Which of the following approaches best demonstrates professional best practice in delivering this insurance service? Option A. Focus primarily on securing the lowest possible premium for a CGL policy, assuring the client that cost-effectiveness is the most important factor in their protection. Option B. Advise the client that CGL policies are designed to cover everything that could go wrong in a business and that they should not worry about specific details. Option C. Immediately issue the broadest available CGL policy with minimal discussion, assuring the client that it will cover all potential liabilities. Option D. Conduct a detailed needs analysis of the client's specific business operations, potential exposures, and risk management strategies. Then explain the scope of a standard CGL policy, including its key insuring agreements, common exclusions, and limitations, to ensure the client understands what is and is not covered. The correct answer is D. Conduct a detailed needs analysis of the client's specific business operations, potential exposures, and risk management strategies. Then explain the scope of a standard CGL policy, including its key insuring agreements, common exclusions, and limitations, to ensure the client understands what is and is not covered. Explanation. This scenario is professionally challenging because it requires the insurance professional to balance the client's immediate desire for broad coverage with the insurer's need to accurately assess and price risk, adhering to regulatory requirements for policy issuance. Misinterpreting or misrepresenting the scope of commercial general liability, CGL, coverage can lead to significant financial and legal repercussions for both the client and the insurer, and can also result in regulatory sanctions. The correct approach involves a thorough needs analysis and clear communication of CGL policy limitations. This is best professional practice because it ensures the client understands what is and is not covered, allowing them to make informed decisions about their insurance program. Specifically, it aligns with the regulatory expectation that insurance products are sold based on accurate representations of coverage. The Insurance Act 2015, assuming UK jurisdiction for AIS 25, mandates that clients must provide fair presentation of the risk, and conversely, insurers and their representatives must provide clear and accurate information about the products offered. This approach upholds the principle of utmost good faith, uberrimi fidei, which underpins insurance contracts. An incorrect approach would be to immediately agree to provide the broadest possible CGL coverage without a detailed discussion of the client's specific operations and potential exposures. This fails to meet the regulatory requirement for a proper risk assessment and could lead to the issuance of a policy that does not adequately address the client's actual needs or that exposes the insurer to unforeseen risks, potentially violating principles of prudent underwriting and fair representation. Another incorrect approach is to simply state that CGL covers everything that could go wrong in a business. This is a gross oversimplification and a misrepresentation of CGL policy terms. CGL policies have specific exclusions and limitations, and failing to explain these is a breach of duty of care and potentially a breach of regulatory codes of conduct regarding clear and accurate product information. A third incorrect approach is to focus solely on the premium cost without adequately explaining the coverage provided. While cost is a factor, it should not overshadow the fundamental need to ensure the client understands the scope and limitations of the insurance they are purchasing. This prioritizes a sale over responsible advice and can lead to client dissatisfaction and claims disputes later. The professional decision-making process should involve a structured needs analysis, including understanding the client's business operations, identifying potential liabilities, and then explaining how a CGL policy, with its specific insuring agreements, exclusions, and conditions, addresses those risks. This involves active listening, clear explanation, and confirmation of understanding, ensuring compliance with both regulatory obligations and ethical standards of client care. Question 8. Stakeholder feedback indicates that some clients purchasing variable life insurance policies are expressing confusion regarding the investment component and its associated risks. As an insurance advisor, what is the most appropriate course of action when discussing variable life insurance with a prospective client who has expressed interest in its growth potential? Option A. Clearly explain that variable life insurance is a security product, detailing its investment component, the associated market risks, and the fact that the cash value is not guaranteed and can fluctuate based on investment performance. Option B. Focus on the commission earned from selling variable life insurance, explaining how this incentivizes the advisor to find the best investment options for the client. Option C. Emphasize the tax-deferred growth potential of variable life insurance, highlighting how it can outperform traditional savings accounts over the long term. Option D. Present variable life insurance as a safe and secure way to build wealth, similar to a fixed annuity, where the cash value is protected from market downturns. The correct answer is A. Clearly explain that variable life insurance is a security product, detailing its investment component, the associated market risks, and the fact that the cash value is not guaranteed and can fluctuate based on investment performance. Explanation. Scenario analysis. This scenario is professionally challenging because it requires the advisor to navigate the complex interplay between a client's stated financial goals and the inherent risks and features of variable life insurance. The advisor must ensure that the client's understanding is accurate and that the product recommendation aligns with their risk tolerance and long-term objectives, rather than solely focusing on the product's potential for growth or the commission it may generate. Misrepresenting the product's nature or its suitability can lead to significant client dissatisfaction, financial harm, and regulatory repercussions. Correct approach analysis. The correct approach involves a thorough and transparent discussion with the client about the nature of variable life insurance, specifically highlighting its investment component, associated risks, market fluctuations, potential loss of principal, and the fact that it is a security product requiring registration. This approach prioritizes client education and informed consent, ensuring the client understands that the policy's cash value is not guaranteed and can decrease. This aligns with regulatory requirements for suitability and fair dealing, emphasizing the advisor's fiduciary or best interest duty to act in the client's best interest by providing accurate and complete information. Incorrect approaches analysis. Recommending variable life insurance solely based on its potential for tax-deferred growth without adequately explaining the investment risks, and the fact that it is a security product, is a failure to provide complete and accurate information. This misrepresents the product's nature and can lead to a client making an investment decision based on incomplete understanding, violating suitability and fair dealing principles. Focusing primarily on the commission structure associated with variable life insurance when discussing the product with the client creates a conflict of interest. This suggests that the recommendation may be driven by personal gain rather than the client's best interests, which is a direct violation of ethical standards and potentially regulatory requirements concerning conflicts of interest. Presenting variable life insurance as a guaranteed investment vehicle, similar to a fixed annuity or a savings account, is a material misrepresentation. This fundamentally misunderstands or miscommunicates the core risk associated with the investment component of variable life insurance, where the cash value is subject to market performance and can decline. This is a serious breach of regulatory obligations regarding product disclosure and suitability. Professional reasoning. Professionals should adopt a client-centric approach, prioritizing education and transparency. This involves a comprehensive needs analysis, followed by a clear explanation of product features, benefits, risks, and costs. Advisors must identify and disclose any potential conflicts of interest and ensure that recommendations are based on the client's best interests, supported by documented evidence of suitability. When dealing with complex products like variable life insurance, it is crucial to ensure the client fully comprehends the investment risks and the product's dual nature as both insurance and an investment. Question 9. Risk assessment procedures indicate that a client, a small manufacturing firm, has identified basic property damage and public liability as their primary concerns. However, the intermediary suspects there may be other significant risks related to their supply chain disruptions and potential product recall due to a new component they are incorporating. Which approach to risk identification best aligns with regulatory requirements and professional best practice? Option A. Focus only on the most common and easily insurable risks for manufacturing businesses. Option B. Rely on a standardized checklist of risks without delving into the specifics of the client's new component or supply chain. Option C. Conduct a detailed analysis of the client's supply chain, the new component's implications, and potential recall scenarios, in addition to addressing the client's stated concerns. Option D. Accept the client's stated risks as the sole basis for coverage recommendations. The correct answer is D. Accept the client's stated risks as the sole basis for coverage recommendations. Explanation. This scenario is professionally challenging because it requires an insurance intermediary to balance the need for comprehensive risk identification with the practical constraints of client engagement and the regulatory obligation to act in the client's best interest. The intermediary must not only understand the client's business, but also anticipate potential risks that the client might overlook or underestimate. This requires a proactive and analytical approach, going beyond simply accepting the client's self-assessment. The correct approach involves a systematic and thorough process of identifying potential risks by considering various facets of the client's operations, industry, and external environment. This includes actively probing for information, asking clarifying questions, and utilizing industry knowledge to uncover less obvious risks. This aligns with the regulatory framework's emphasis on ensuring that clients receive appropriate advice and that their insurance coverage is tailored to their actual needs, thereby fulfilling the duty to act with due skill, care, and diligence. Ethically, this demonstrates a commitment to client welfare and professional integrity. An incorrect approach that relies solely on the client's stated risks is professionally unacceptable because it abdicates the intermediary's responsibility to provide expert advice. This failure to conduct an independent and thorough risk assessment could lead to underinsurance or inadequate coverage, exposing the client to significant financial loss. This breaches the regulatory requirement to provide advice that is suitable for the client's circumstances and could be considered a failure to act in the client's best interest. Another incorrect approach that focuses only on the most obvious or frequently insured risks neglects the potential for less common but potentially catastrophic events. This superficial analysis fails to meet the standard of care expected of a professional insurance intermediary and could leave the client vulnerable. It also fails to uphold the regulatory expectation of providing comprehensive advice. A third incorrect approach that prioritizes speed and efficiency over thoroughness by quickly ticking boxes without deep engagement is also professionally unacceptable. This approach prioritizes the intermediary's convenience over the client's protection and is a direct contravention of the duty to act with due skill, care, and diligence. It fails to identify all material risks, thereby undermining the purpose of insurance advice. The professional decision-making process for similar situations should involve a structured risk identification framework. This framework should include understanding the client's business objectives, operational processes, financial exposures, and legal/regulatory obligations. It should also involve considering external factors such as market trends, technological advancements, and environmental changes. The intermediary should employ active listening, critical questioning, and leverage their expertise and available resources to build a comprehensive risk profile. This ensures that the advice provided is robust, client-centric, and compliant with all regulatory and ethical standards. Question 10. The monitoring system demonstrates that an insurance advisor has recommended a specific investment-linked insurance product to a client. While the recommended product is suitable for the client's stated objectives, an alternative product, also suitable and available through the same insurer, offers a significantly lower premium for comparable benefits and a lower commission for the advisor. The advisor has not explicitly discussed the alternative product or the commission difference with the client. Which approach best upholds the advisor's fiduciary duty? Option A. Recommend the higher commission product but provide the client with a generic disclosure document that mentions commission structures without detailing specific differences for this recommendation. Option B. Immediately halt the recommendation process and inform the client about the alternative product, explaining the differences in premiums, benefits, and advisor commissions, and then recommend the product that offers the best overall value to the client. Option C. Recommend the higher commission product, justifying it by highlighting its specific features that might appeal to the client, without mentioning the existence or suitability of the lower-cost alternative. Option D. Proceed with the recommendation of the higher commission product, as it is suitable, and the client has not specifically asked for the lowest-cost option. The correct answer is D. Proceed with the recommendation of the higher commission product, as it is suitable, and the client has not specifically asked for the lowest cost option. Explanation. The monitoring system demonstrates a potential conflict of interest where an insurance advisor is recommending a product that offers a higher commission to themselves, rather than the product that best suits the client's stated needs and financial situation. This scenario is professionally challenging because it pits the advisor's personal financial gain against their fundamental obligation to act in the client's best interest. The core of the challenge lies in maintaining objectivity and transparency when personal incentives are present. Careful judgment is required to ensure that all recommendations are driven by client needs, not advisor commissions. The correct approach involves the advisor prioritizing the client's stated needs and financial capacity above their own potential commission. This means thoroughly assessing the client's situation, explaining all suitable product options with their respective benefits and drawbacks, and clearly disclosing any potential conflicts of interest, including commission structures. The advisor must then recommend the product that demonstrably offers the best value and suitability for the client, even if it yields a lower commission for themselves. This aligns with the fiduciary duty, which mandates acting with utmost good faith, loyalty, and in the best interests of the client. Regulatory frameworks for insurance services typically impose a duty of care and a requirement to avoid conflicts of interest or to manage them transparently and effectively, ensuring client protection. An incorrect approach would be to recommend the higher commission product without a thorough, documented assessment of its suitability for the client, or without disclosing the commission differential. This constitutes a breach of fiduciary duty by prioritizing personal gain over client welfare. It also violates regulatory requirements for transparency and fair dealing, potentially misleading the client and exposing the advisor and their firm to disciplinary action, fines, and reputational damage. Another incorrect approach is to recommend a product that is technically suitable but not the most cost-effective or beneficial option available to the client, simply because it offers a slightly better commission than other equally suitable alternatives. This still falls short of the fiduciary obligation to secure the best possible outcome for the client. A further incorrect approach is to fail to disclose the commission structure entirely, even if the recommended product is suitable. While the product might be appropriate, the lack of transparency about how the advisor benefits from the recommendation erodes trust and prevents the client from making a fully informed decision, which is a cornerstone of ethical and regulatory compliance in insurance services. The professional decision-making process for similar situations should involve a clear hierarchy of priorities: client needs first, then regulatory compliance, and finally, personal compensation. Advisors should regularly review their product recommendations against client objectives and commission structures, seeking guidance or second opinions when conflicts arise. A robust internal compliance framework that encourages disclosure and prioritizes client outcomes is essential. Question 11. The monitoring system demonstrates a consistent pattern of customer complaints regarding the clarity of policy renewal documents over the past quarter. Which of the following actions best aligns with regulatory expectations for delivering insurance services and ensuring a positive customer experience? Option A. Conducting a thorough review of the policy renewal document content and design to identify areas of ambiguity and subsequently revising the documents for improved clarity. Option B. Implementing a mandatory training session for all customer-facing staff on how to verbally explain renewal terms to customers. Option C. Escalating all future complaints regarding renewal documents directly to senior management for individual assessment. Option D. Issuing a blanket apology to all customers who have lodged similar complaints and offering a small goodwill gesture. Correct answer is B. Implementing a mandatory training session for all customer-facing staff on how to verbally explain renewal terms to customers. Explanation. This scenario is professionally challenging because it requires balancing efficient complaint handling with the regulatory obligation to ensure fair treatment of customers and accurate record keeping. The challenge lies in identifying and addressing systemic issues that lead to customer dissatisfaction, rather than just resolving individual complaints. Careful judgment is required to determine if the observed trend represents a minor anomaly or a significant breach of service standards and regulatory expectations. The correct approach involves a proactive and thorough investigation into the root causes of the recurring complaint. This demonstrates a commitment to customer experience and regulatory compliance by identifying and rectifying underlying process failures. Specifically, it aligns with the regulatory expectation for insurers to have robust complaint handling procedures that not only resolve individual issues, but also identify and address systemic problems to prevent future occurrences. This proactive stance helps maintain customer trust and avoids potential regulatory scrutiny for failing to address recurring service failures. An approach that focuses solely on individual complaint resolution, without investigating the underlying trend, fails to meet regulatory expectations for continuous improvement and proactive risk management. This can lead to repeated customer dissatisfaction and a perception that the insurer is not adequately addressing service issues. An approach that dismisses the trend as insignificant without proper investigation risks overlooking a systemic problem that could have broader implications for customer outcomes and regulatory compliance. This could be interpreted as a failure to act in the best interests of customers. An approach that involves superficial data analysis without delving into the qualitative aspects of the complaints may miss crucial insights into the customer experience. This could lead to ineffective solutions that do not address the true nature of the dissatisfaction. The professional decision-making process for similar situations should involve 1. Recognizing and acknowledging the pattern identified by the monitoring system. 2. Initiating a comprehensive review to understand the root cause of the recurring complaints, considering both quantitative data and qualitative feedback. 3. Implementing targeted corrective actions to address the identified root causes. 4. Monitoring the effectiveness of these actions and making further adjustments as necessary. 5. Documenting the process and outcomes for internal review and potential regulatory reporting. Question 12. The monitoring system demonstrates a trend where customers inquiring about protection against financial losses arising from damage to their physical business premises and the associated interruption of operations are frequently being offered policies that primarily cover third-party claims for bodily injury or property damage. Which type of insurance is most likely being inappropriately offered in these scenarios? Option A, property insurance. Option B, business interruption insurance. Option C, general liability insurance. Option D, professional indemnity insurance. The correct answer is C, general liability insurance. Explanation: the monitoring system demonstrates a pattern of customer inquiries that require careful consideration of the appropriate insurance product to meet their needs. This scenario is professionally challenging because misidentifying the type of insurance can lead to significant financial detriment for the customer, regulatory breaches for the firm, and damage to professional reputation. It requires a deep understanding of various insurance types and their specific applications, moving beyond superficial descriptions to grasp the core purpose and coverage of each. The correct approach involves accurately identifying the customer's primary risk exposure and matching it to the insurance product designed to cover that specific risk. This means understanding that, while some policies may offer overlapping benefits, the fundamental purpose and scope of coverage differ. For instance, distinguishing between a policy that covers loss of income due to a specific event versus one that covers the cost of repairing or replacing damaged property is crucial. This aligns with the regulatory duty to act in the customer's best interests and to provide suitable advice, ensuring the customer is adequately protected against their identified risks. An incorrect approach would be to recommend a policy based solely on a superficial similarity in wording or a perceived broadness of coverage, without considering the specific nature of the risk. For example, suggesting a general liability policy when the customer's primary concern is the loss of income due to a business interruption would be a failure. This is because general liability typically covers third-party claims for bodily injury or property damage, not the insured's own lost profits. Similarly, recommending a property insurance policy for a situation that primarily involves damage to intangible assets or loss of use without physical damage would be inappropriate. These misalignments represent regulatory failures in providing suitable advice and ethical failures in not adequately addressing the customer's stated needs and underlying risks. Professionals should employ a structured decision-making process. This involves actively listening to and clarifying the customer's stated needs and concerns, identifying the underlying risks associated with those needs, and then systematically evaluating different insurance products based on their core purpose, scope of coverage, and exclusions. This process ensures that the recommended product directly addresses the identified risk and aligns with the customer's objectives, thereby fulfilling regulatory and ethical obligations. Question 13. Process analysis reveals that an insurance advisor has a long-standing personal friendship with the owner of a small business seeking commercial insurance. The advisor knows of a new insurance product that offers slightly better coverage for a similar premium, but it is offered by a competitor with whom the advisor's firm has a less favorable commission structure compared to their usual offerings. The advisor is aware that recommending this competitor's product would result in a lower personal commission. What is the most ethically and regulatorily sound approach for the insurance advisor in this situation? Option A. Inform the business owner about the personal friendship but state that it does not influence their professional judgment and proceed to recommend the advisor's firm's standard product. Option B. Proceed with recommending the competitor's product without mentioning the personal friendship or the commission difference, assuming the client will benefit most from the better coverage. Option C. Disclose the personal friendship and the potential commission difference to the business owner, explain the benefits of the new product, and allow the business owner to make an informed decision, offering to facilitate the purchase if desired. Option D. Recommend the advisor's firm's standard product, highlighting its benefits and downplaying the existence of the competitor's product as a minor alternative. Correct answer is C. Disclose the personal friendship and the potential commission difference to the business owner, explain the benefits of the new product, and allow the business owner to make an informed decision, offering to facilitate the purchase if desired. Explanation: this scenario presents a common ethical challenge in insurance services, navigating potential conflicts of interest that could compromise client best interests and regulatory compliance. The professional challenge lies in balancing business objectives with the fiduciary duty owed to clients, ensuring that personal gain or relationships do not influence advice or product recommendations. Careful judgment is required to identify, disclose, and manage these conflicts transparently. The correct approach involves prioritizing the client's interests above all else. This means proactively identifying any situation where personal interests might diverge from the client's, disclosing this potential conflict to the client clearly and comprehensively, and then seeking the client's informed consent to proceed or offering alternative solutions that eliminate the conflict. This aligns with the core principles of acting with integrity and in the best interests of the client, as mandated by regulatory frameworks governing insurance professionals, which emphasize transparency and client protection. An incorrect approach would be to proceed without disclosing the potential conflict. This failure to inform the client breaches the duty of transparency and can lead to the client making decisions based on incomplete information, potentially resulting in unsuitable product choices or financial detriment. Such an action undermines client trust and violates regulatory requirements for disclosure of conflicts of interest. Another incorrect approach is to downplay the significance of the conflict to the client. While disclosure might be made, if the potential impact on the client's decision-making is minimized or misrepresented, it does not constitute genuine informed consent. This is ethically unsound and regulatorily deficient, as it fails to equip the client with the full picture necessary to make an independent and informed choice. A further incorrect approach is to assume that because the product is generally suitable, the conflict is irrelevant. Regulatory frameworks require disclosure and management of conflicts regardless of the inherent suitability of the product. The potential for bias in the recommendation process itself is the issue, not solely the outcome. Ignoring this potential bias, even with a suitable product, can still lead to a breach of professional duty. The professional decision-making process for similar situations should involve a structured approach. 1. Identification. Recognize situations where personal interests, financial, relational, or otherwise, could influence professional judgment. 2. Assessment. Evaluate the nature and significance of the potential conflict and its impact on the client. 3. Disclosure. Communicate the conflict clearly, honestly, and in a manner the client can understand. 4. Consent/mitigation. Obtain informed client consent to proceed, or take steps to eliminate or mitigate the conflict, such as offering alternative options or recusing oneself from the recommendation. 5. Documentation. Record the identified conflict, the disclosure made, and the client's decision. Question 14. The risk matrix shows a proposal for a property insurance policy where the applicant is a close friend of the property owner, who is currently overseas. The applicant states they want to ensure the property is protected from damage while the owner is away, as they are concerned about its upkeep and potential for vandalism. The applicant has no legal ownership, mortgage, or other financial claim on the property. Which of the following approaches best demonstrates adherence to the principle of insurable interest? Option A. Issue the policy to the applicant, noting their concern for the property's protection as sufficient justification. Option B. Advise the applicant to get a letter from the owner stating their desire for the property to be insured, which should suffice. Option C. Suggest the applicant obtain a power of attorney from the owner, which would then establish a clear insurable interest. Option D. Advise the applicant that they do not appear to have an insurable interest in the property, and therefore the policy cannot be issued to them. The correct answer is D. Advise the applicant that they do not appear to have an insurable interest in the property, and therefore the policy cannot be issued to them. Explanation. This scenario is professionally challenging because it requires the insurance professional to distinguish between a speculative interest and a genuine insurable interest, which is a fundamental principle of insurance law. Misinterpreting this distinction can lead to the issuance of a policy that is void from the outset, causing financial loss to both the insurer and the policyholder, and potentially leading to regulatory sanctions. Careful judgment is required to ensure that the proposed policy aligns with the legal and ethical requirements of insurable interest. The correct approach involves recognizing that the individual has a direct financial stake in the subject matter of the insurance. This means they would suffer a loss if the insured event occurred. This aligns with the core principle of insurable interest, which dictates that the policyholder must have a legitimate financial or personal interest in the insured item or person. Without this, the contract of insurance would be akin to a wager, which is not permitted. An incorrect approach would be to issue the policy based solely on the individual's stated desire to protect the asset, without verifying their actual financial connection. This fails to uphold the regulatory requirement that an insurable interest must exist at the time the policy is taken out. Issuing a policy without a valid insurable interest renders the contract void ab initio, meaning it was never legally valid. Another incorrect approach would be to assume that any expressed concern about an asset equates to an insurable interest. This overlooks the legal definition, which requires a demonstrable financial loss. For instance, a neighbor expressing concern about a property's safety does not automatically grant them an insurable interest in that property. A further incorrect approach would be to proceed with issuing the policy if the individual is merely a friend or acquaintance of the owner, without any legal or financial relationship. This would be a speculative interest, not an insurable one, and would violate the principle that insurance is for indemnification against loss, not for speculative gain or protection of another's property without a vested interest. Professionals should employ a decision-making framework that prioritizes verification of insurable interest. This involves asking probing questions to establish the nature of the relationship between the individual and the subject of insurance, and the potential for direct financial loss. If doubt exists, seeking clarification or declining to issue the policy until the insurable interest is clearly established is the prudent and compliant course of action. Question 15. What factors determine the suitability of a whole life insurance policy for a client seeking permanent life insurance coverage, beyond their initial stated desire for lifelong protection? Option A. The client's current age, health status, financial capacity to afford ongoing premiums, long-term financial goals, e.g., estate planning, legacy creation, and understanding of the policy's cash value accumulation and surrender options. Option B. The advisor's commission structure for selling whole life insurance policies, which incentivizes recommending this product over others. Option C. The client's desire for a policy that can be easily surrendered for cash within the first few years to fund short-term financial needs. Option D. The client's preference for a policy with a guaranteed death benefit, regardless of their financial stability or other competing financial priorities. The correct answer is A. The client's current age, health status, financial capacity to afford ongoing premiums, long-term financial goals, e.g., estate planning, legacy creation, and understanding of the policy's cash value accumulation and surrender options. Explanation. This scenario is professionally challenging because it requires an insurance advisor to balance the client's stated needs with a comprehensive understanding of whole life insurance products and their suitability, while adhering strictly to regulatory obligations regarding disclosure and advice. The advisor must avoid misrepresenting the product or pushing a solution that doesn't align with the client's financial objectives and risk tolerance, especially given the long-term nature of whole life insurance. The correct approach involves a thorough needs analysis that goes beyond the client's initial request. This includes understanding the client's financial goals, time horizon, risk tolerance, and existing financial commitments. The advisor must then explain the features, benefits, and limitations of whole life insurance, including its cash value accumulation, death benefit, and premium structure, in a clear and understandable manner. Crucially, the advisor must ensure the client comprehends that whole life insurance is a long-term commitment with potentially higher premiums than term life insurance, and that its primary purpose is lifelong protection and potential estate planning benefits, rather than short-term savings or investment. This aligns with regulatory requirements to provide advice that is in the client's best interest and to ensure adequate disclosure of product features and associated costs. An incorrect approach would be to immediately recommend whole life insurance based solely on the client's expressed desire for permanent coverage, without probing deeper into their financial situation and objectives. This fails to meet the regulatory obligation to conduct a comprehensive needs analysis and could lead to the client purchasing a product that is not suitable or affordable for them. Another incorrect approach would be to overemphasize the cash value growth potential of whole life insurance without adequately explaining the associated risks, fees, and the fact that it is not a primary investment vehicle. This misrepresentation could mislead the client about the product's performance and purpose, violating disclosure requirements, and potentially leading to client dissatisfaction and regulatory scrutiny. Finally, recommending whole life insurance without comparing it to alternative solutions, such as term life insurance, would be a failure to provide comprehensive advice, as the client may be better served by a different product depending on their specific circumstances. Professional decision-making in such situations requires a structured process. First, actively listen to and understand the client's stated needs and underlying motivations. Second, conduct a detailed fact-find to gather information about their financial situation, goals, and risk profile. Third, educate the client about relevant product types, including their features, benefits, limitations, and costs, using clear and jargon-free language. Fourth, assess the suitability of different products based on the gathered information and client objectives. Fifth, present a recommendation that is clearly in the client's best interest, supported by a rationale that explains why it is the most appropriate solution, and provide clear disclosure of all material information. Question 16. Examination of the data shows that a large employer is seeking to renew its group health insurance policy. The employer has expressed a strong desire to significantly reduce premium costs for the upcoming year and has indicated a preference for policies with minimal administrative complexity. The employee demographic includes a substantial number of individuals with chronic health conditions who rely heavily on ongoing medical treatment and prescription drugs. What is the most appropriate course of action for the insurance professional? Option A. Recommend the policy with the absolute lowest premium available, as this directly addresses the employer's primary objective of cost reduction, and assume employees will manage any coverage gaps. Option B. Suggest a policy that excludes coverage for pre-existing conditions to reduce the overall risk pool and therefore the premium, without thoroughly explaining the implications of such exclusions to the employer. Option C. Advise the employer to select a high-deductible health plan with limited prescription drug coverage to achieve the maximum possible cost savings, without further investigation into the specific needs of employees with chronic conditions. Option D. Research and present a range of group health insurance options that balance cost-effectiveness with comprehensive coverage for the employee demographic, highlighting policies that offer robust benefits for chronic condition management and prescription drugs, and clearly explaining any trade-offs between premium cost and benefit levels. The correct answer is D. Research and present a range of group health insurance options that balance cost-effectiveness with comprehensive coverage for the employee demographic, highlighting policies that offer robust benefits for chronic condition management and prescription drugs, and clearly explaining any trade-offs between premium cost and benefit levels. Explanation. This scenario presents a professional challenge because it requires balancing the employer's desire to control costs with the ethical obligation to ensure employees have access to necessary health coverage. The insurance professional must navigate potential conflicts of interest and uphold principles of fairness and transparency. Careful judgment is required to avoid actions that could be perceived as discriminatory or detrimental to employee well-being, while still operating within the bounds of group insurance principles and regulatory requirements. The correct approach involves proactively identifying and addressing potential gaps in coverage for a specific employee group by exploring alternative policy options that meet their unique needs. This demonstrates a commitment to client service and adherence to the principle of providing suitable insurance solutions. Specifically, it aligns with the ethical duty to act in the best interests of the client, the employer, and its employees, and to provide advice that is appropriate for their circumstances. Regulatory frameworks often emphasize the importance of ensuring that group policies are not designed in a way that unfairly excludes or disadvantages certain employee segments, and that insurers act with due diligence in assessing and meeting client needs. An incorrect approach that prioritizes cost savings above all else, without thoroughly investigating the impact on employee health needs, fails to meet the ethical standard of client care. This could lead to a policy that, while cheaper, leaves employees vulnerable or unable to access essential medical services, potentially violating the spirit, if not the letter, of regulations designed to ensure adequate coverage. Another incorrect approach, which involves recommending a policy based solely on the employer's stated preference for the lowest premium, without exploring other options or explaining the trade-offs, is ethically problematic. It neglects the professional responsibility to provide comprehensive advice and to ensure the employer understands the implications of their choices for their employees' health security. This could be seen as a failure to act with due skill, care, and diligence. A further incorrect approach, which involves suggesting a policy that might exclude pre-existing conditions without fully explaining the implications or exploring alternatives that offer better protection, is also ethically unsound. While some policies may have exclusions, The professional duty is to ensure the client is fully informed and that the chosen policy, within regulatory limits, provides the best possible coverage for the group's needs. The professional decision-making process in such situations should involve a thorough needs assessment of the employee group, a comprehensive review of available policy options, a clear explanation of the benefits, limitations, and costs of each option to the employer, and a recommendation based on a holistic understanding of the employer's objectives and the employee's health requirements, all within the applicable regulatory framework. Question 17. When evaluating the suitability of an international life insurance policy for a client residing in Australia and the policy is issued by a UK-based insurer, which of the following actions demonstrates the most compliant and ethically sound approach? Option A. Conducting a thorough review of both Australian financial services regulations, administered by a SIC, pertaining to the provision of financial advice and the sale of insurance products to Australian residents, and the UK's regulatory requirements for offshore insurance, to ensure full compliance with both jurisdictions. Option B. Relying solely on the UK insurer's documentation, which states the policy is compliant with international standards, without independently verifying specific Australian regulatory obligations. Option C. Proceeding with the recommendation after confirming the UK insurer is regulated by the Financial Conduct Authority, FCA, and assuming Australian regulatory requirements are met by default. Option D. Advising the client to seek independent legal counsel in the UK to understand the policy's terms, without addressing the Australian regulatory implications of the advice being provided. The correct answer is C. Proceeding with the recommendation after confirming the UK insurer is regulated by the Financial Conduct Authority, FCA, and assuming Australian regulatory requirements are met by default. Explanation: this scenario is professionally challenging because it requires navigating the complexities of cross-border insurance regulations, which can vary significantly between jurisdictions. A financial advisor must ensure they are acting within the legal and ethical boundaries of both the client's domicile and the jurisdiction where the insurance product is offered. Misunderstanding or misapplying these regulations can lead to severe penalties, reputational damage, and harm to the client. The correct approach involves a thorough understanding of the regulatory framework governing cross-border insurance sales in both the client's home country and the country where the insurer is based. This includes identifying any specific licensing requirements, disclosure obligations, and consumer protection laws that apply. By consulting with legal and compliance experts familiar with both jurisdictions, the advisor can ensure that any advice or product recommendation adheres strictly to all applicable laws and regulations, thereby protecting both the client and themselves. This diligent approach prioritizes regulatory compliance and client welfare above all else. An incorrect approach would be to assume that the regulations of the client's home country are sufficient and that the insurer's home country regulations are irrelevant. This fails to acknowledge that the act of selling an insurance product to a resident, even if facilitated remotely, often triggers regulatory oversight in the client's jurisdiction. Another incorrect approach is to rely solely on the insurer's assurances without independent verification of compliance with the client's local regulations. This demonstrates a lack of due diligence and an abdication of professional responsibility. Finally, proceeding without understanding the specific disclosure requirements for cross-border transactions, such as informing the client about potential differences in legal recourse or tax implications, is a significant regulatory and ethical failure. Professionals should adopt a decision-making framework that begins with identifying the jurisdictions involved in the transaction. This should be followed by a comprehensive review of the relevant regulatory frameworks in each jurisdiction, seeking expert advice where necessary. The advisor must then assess the specific product and service being offered against these regulations, ensuring all disclosure and suitability requirements are met. A commitment to ongoing education and staying abreast of changes in cross-border regulations is also crucial for maintaining professional integrity and client trust. Question 18. Operational review demonstrates that an insurance agent, when processing a new life insurance application, has been requesting consumer reports from a credit reporting agency without explicitly informing the applicant that such a report would be obtained for underwriting purposes or securing their written authorization beforehand. The agent believes this is a standard practice to assess risk efficiently. Which of the following actions best aligns with the requirements of the Fair Credit Reporting Act, FCRA, for obtaining consumer reports for insurance underwriting? Option A. Rely on the applicant's signature on the general insurance application form, assuming it implicitly grants permission to obtain any necessary reports for underwriting. Option B. Obtain the consumer report without any prior disclosure or consent, as the agent deems it essential for accurate risk assessment and underwriting. Option C. Request the consumer report immediately upon receiving the application, and then inform the applicant that a report was obtained for underwriting as part of the policy issuance process. Option D. Obtain the applicant's written consent, specifically authorizing the insurer to obtain a consumer report for insurance underwriting purposes, and provide a clear and conspicuous disclosure of this intent to the applicant before requesting the report. The correct answer is D. Obtain the applicant's written consent, specifically authorizing the insurer to obtain a consumer report for insurance underwriting purposes, and provide a clear and conspicuous disclosure of this intent to the applicant before requesting the report. Explanation. This scenario presents a professional challenge because it requires an insurance agent to balance the need for accurate underwriting information with the consumer's right to privacy and fair treatment under the Fair Credit Reporting Act, FCRA. The agent must understand the permissible purposes for obtaining consumer reports and the specific requirements for disclosure and consent. Failure to adhere to FCRA can result in significant legal penalties and damage to the insurer's reputation. The correct approach involves obtaining the applicant's written consent before requesting a consumer report for underwriting purposes. This aligns directly with FCRA mandate that consumer reports may only be furnished for permissible purposes, and obtaining a report for insurance underwriting is a permissible purpose, provided the consumer has been informed and has authorized the disclosure. The FCRA requires that if a consumer report is obtained for insurance underwriting, the entity must provide the consumer with a clear and conspicuous disclosure of this fact and obtain their written authorization. This ensures transparency and consumer control over their personal information. An incorrect approach would be to obtain a consumer report without informing the applicant or obtaining their consent, even if the agent believes it is necessary for underwriting. This directly violates FCRA disclosure and authorization requirements, treating the consumer report as if it were public information or accessible without restriction. Another incorrect approach would be to obtain the report and then only disclose its use to the applicant after the report has already been reviewed. This is a procedural failure, as FCRA requires disclosure and authorization before obtaining the report for underwriting. Finally, an incorrect approach would be to rely on a general, non-specific consent form that does not clearly state that a consumer report will be obtained for insurance underwriting purposes. FCRA emphasizes clear and conspicuous disclosure, meaning the consumer must understand what they are consenting to. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves 1. Identifying the specific regulatory requirements applicable to the situation, in this case, FCRA. 2. Understanding the consumer's rights under those regulations. 3. Implementing procedures that ensure all necessary disclosures are made and all required authorizations are obtained prior to taking action that impacts the consumer's information. 4. Regularly reviewing internal processes to ensure ongoing compliance. Question 19. Strategic planning requires an insurance intermediary to consider the most appropriate course of action when a client suffers a loss due to an insurer's admitted breach of a policy contract, and the intermediary's prior advice may have influenced the policy terms. Which of the following represents the most professionally responsible and regulatorily compliant approach for the intermediary? Option A. Advise the client to seek legal counsel to explore all available remedies for breach of contract, including seeking damages that would place them in the position they would have been in had the contract been fulfilled, and offer to assist in gathering relevant documentation. Option B. Suggest that the client immediately initiate legal proceedings against the insurer without first exploring negotiation or mediation options. Option C. Recommend that the client accept the insurer's initial settlement offer, as it is often the quickest way to resolve the matter and avoid further complications. Option D. Inform the client that due to the insurer's size and reputation, pursuing further action is unlikely to be successful, and that they should consider the loss as a learning experience. The correct answer is A. Advise the client to seek legal counsel to explore all available remedies for breach of contract, including seeking damages that would place them in the position they would have been in had the contract been fulfilled, and offer to assist in gathering relevant documentation. Explanation: this scenario is professionally challenging because it requires an insurance intermediary to navigate a situation where a client has suffered a loss due to a breach of contract by an insurer, and the intermediary's advice may have contributed to the client's predicament. The intermediary must act with integrity and competence, ensuring the client receives appropriate recourse while adhering to regulatory obligations. Careful judgment is required to balance the client's interests with the intermediary's professional responsibilities and the legal framework governing insurance contracts. The correct approach involves advising the client on the available legal remedies for breach of contract, specifically focusing on damages that aim to put the client in the position they would have been in had the contract been performed. This includes seeking compensation for the financial losses directly attributable to the insurer's failure to meet its contractual obligations. This approach is ethically sound and regulatorily compliant, as it upholds the principle of acting in the client's best interest and fulfilling the intermediary's duty of care. It aligns with the regulatory framework's emphasis on ensuring clients understand their rights and have access to appropriate redress when an insurer breaches its contractual duties. An incorrect approach would be to advise the client to accept a minimal settlement offer from the insurer without exploring all available legal remedies. This fails to act in the client's best interest and could be seen as a breach of the intermediary's duty of care, potentially exposing the intermediary to liability. It also undermines the regulatory objective of ensuring fair treatment of consumers and access to justice. Another incorrect approach would be to suggest that the client has no recourse because the insurer is a large, established entity. This demonstrates a lack of understanding of contract law and the remedies available for breach, and it discourages the client from pursuing legitimate claims. This is ethically unacceptable and fails to meet the professional standards expected of an insurance intermediary. A further incorrect approach would be to advise the client to pursue litigation without first exploring alternative dispute resolution mechanisms or seeking legal counsel. While litigation may be a necessary step, it is often costly and time-consuming. An intermediary should guide the client towards a balanced approach that considers all options for resolution, including negotiation and mediation, before resorting to court action, unless the circumstances clearly warrant immediate litigation. This approach neglects the intermediary's duty to provide comprehensive and practical advice. The professional decision-making process for similar situations should involve 1. Thoroughly understanding the client's situation and the nature of the insurer's breach. 2. Identifying all potential contractual and legal remedies available to the client. 3. Explaining these remedies clearly and comprehensively to the client, including potential outcomes and associated risks. 4. Advising the client on the most appropriate course of action, which may involve negotiation, alternative dispute resolution, or legal proceedings. 5. Ensuring the client is empowered to make informed decisions about their claim. 6. Maintaining professional integrity and acting at all times in the client's best interest, in accordance with regulatory requirements and ethical standards. Question 20. Regulatory review indicates that when explaining insurance products influenced by actuarial science, such as life insurance or annuities, insurance service providers must ensure clients understand the basis of pricing and benefit projections. Which of the following best describes the most appropriate method for an insurance professional to convey this information to a client? Option A. Providing a clear, simplified explanation of the key factors influencing premiums and benefits, such as mortality, investment growth, and expenses, while highlighting that these are projections with inherent uncertainties. Option B. Emphasizing the competitive nature of the premium and benefit figures, suggesting they are the best available without detailing the underlying actuarial assumptions. Option C. Presenting a detailed breakdown of the actuarial formulas and statistical models used to derive premiums and benefits, assuming the client possesses a strong mathematical background. Option D. Focusing solely on the final premium amount and projected benefit payout, assuring the client that these figures are guaranteed and will not change. The correct answer is C. Presenting a detailed breakdown of the actuarial formulas and statistical models used to derive premiums and benefits, assuming the client possesses a strong mathematical background. Explanation: this scenario is professionally challenging because it requires an insurance professional to balance the technical insights derived from actuarial science with the practical realities of delivering insurance services to clients, all while adhering to regulatory requirements. The core challenge lies in translating complex actuarial assumptions into understandable and actionable advice for customers, ensuring transparency and fairness. Careful judgment is required to avoid misrepresenting the implications of actuarial models or creating unrealistic expectations. The correct approach involves clearly communicating the basis of actuarial assumptions, including their inherent uncertainties and limitations, to the client. This means explaining how factors like mortality rates, investment returns, and expense projections influence premium calculations and benefit illustrations without resorting to overly technical jargon. The professional must ensure that the client understands that these are projections based on current data and assumptions, which can change. This aligns with regulatory principles of transparency, fair dealing, and providing information that is not misleading. Ethically, it upholds the duty of care to the client by empowering them with sufficient understanding to make informed decisions. An incorrect approach that focuses solely on presenting the final premium or benefit figures without explaining the underlying actuarial assumptions fails to meet regulatory standards for disclosure. This can be misleading, as the client may not grasp the factors that could lead to future adjustments or variations in these figures. It also breaches the ethical obligation to provide clear and understandable information. Another incorrect approach that oversimplifies actuarial assumptions to make them sound more certain than they are is also professionally unacceptable. This misrepresents the nature of actuarial science, which inherently deals with probabilities and estimations. Such an approach can lead to client dissatisfaction and potential disputes if actual outcomes deviate significantly from the oversimplified projections. It violates the principle of providing accurate and not misleading information. A further incorrect approach that prioritizes sales targets over a thorough explanation of actuarial implications is ethically and regulatorily unsound. This demonstrates a failure to act in the client's best interest and prioritizes commercial gain over client understanding and protection. It directly contravenes the duty of care and the principles of fair conduct expected of insurance professionals. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the actuarial basis of the product being offered. Second, identify the key assumptions and their potential impact on the client. Third, translate this technical information into clear, concise, and client-friendly language, using analogies or simplified explanations where appropriate. Fourth, actively solicit client understanding by asking clarifying questions and encouraging them to ask questions. Finally, always ensure that all communications are consistent with regulatory requirements for disclosure and fair treatment of customers.